Hello and welcome back to the show. So I'm super excited for our guest today, and we are going to be talking all about the benefits of investing in multifamily real estate and some of the details that goes into building a multifamily real estate portfolio as well. So before we kind of get started here, I just want to quickly introduce my guest. His name is Drew Breneman. And interesting fact about him, he started his first business at age 14. And if you guys know a little bit about me, I started my business as young as well, so I really resonate with that. But he purchased his first rental properties at 19 years old and even appeared on HGTV. So, Drew, I'm really excited to have you on the show. I'm really excited to have this conversation with you. I just want to say welcome to the show.
Yeah, happy to be here. Thanks for having me.
Yeah, no, absolutely. So, just right off the bat, right? So, you started your first business at 14. You were obviously very successful in business, at a young age. So, kind of walk us through that story of how you were tinkering with different businesses in kind of like in your childhood days, if you will, and how that led to becoming, a successful multifamily, real estate mogul.
Yeah, well, it's I don't know, I'm still trying to work towards mogul status maybe, but yeah, it's really more just yeah, it really came natural to me where um I mean, I would have been way younger than 14, but even like I was playing some instruments for my parents and my sister was also doing it as well. And the way my mind worked was, okay, we should be charging admission to this concert that I'm putting on as like a 6-year-old. So they paid whatever I asked, a quarter or something, for fun. But yeah, that it was just kind of always like kind of coming naturally. And that I think that the first business when I was 14, what happened was we were at a wedding and one of my relatives, their best friend was a magician, like a real one who does it professionally. And he taught me a couple tricks and they were really good. And I got into performing magic and started doing kids parties. So that was really the first like entrepreneurial endeavor that I did. Where I started like going outside the house, so to speak, and doing it. So, and then I came into, really what kind of got me going in real estate is I started a business in high school where I was buying and selling items in online video games. So I didn't play these games, but really all my friends did. And they were, they'd play the game, then they'd sell their items for real money. And I heard about that. And I was like, this sounds really interesting, not to play the game, but just to make money from it. So I invested $20 or something. I bought an armor set or whatever it was, a bow and arrow. And I went out and I resold it for more. And I was kind of off and going ever since with that business. And over the course of like the next 4 years, from say like freshman year of high school to freshman year of college, I'd had thousands of transactions where I'd come home every day and I have 20, 30 sales that I made on eBay or just directly to past customers. And then I'd make my deliveries, I'd do my homework. So it was really like just like one small little thing at a time. And then I started saving up the money and figuring out what should I do with it. So, and that's when I found out about real estate. I was reading all these investing books that, people they probably read when they're like in their 40s, Rich Dad, Poor Dad, Intelligent Investor, Think and Grow Rich. I read all those books when I was like 16 and 17. And so then I really liked real estate investing from what I had read. And I've been kind of fighting this cough this week, so sorry about that with the clearing the throat. But so I really liked real estate investing. I was reading a book by Gary Eldred. I think it's just called Real Estate Investing. And they broke down just real simply how you make money in real estate, the 4 ways: cash flow, paying your loan down, appreciation, the tax breaks you get. And just kind of hearing that, like the light bulb really went off, where this is a, make money slow kind of combination of investment and business that you'd have a lot more control in versus like the stock market. Because up until that point, the only thing I had invested in was I got a brokerage account opened. And as, a 16, 17-year-old investing, I was really, it was like my investing outlook was way too short term, where I'd buy something for like a day, it would go down and then I'd want to sell it, and so I really liked how real estate, you kind of would make a bet and essentially run like a small business, and benefited kind of every way possible, from tax breaks to just from inflation pushing up the property value, paying your loan down. It made made a ton of sense to me. So
Yeah. Yeah, absolutely, man. So that's awesome that you got started and you were selling, armor sets in video games basically as one of your first successful businesses. So I think that's really interesting, the kind of how you got started and how that led into real estate basically, because a lot of people might not think of that, right? They might think, oh, just people get into real estate just because they are always going to be in real estate, and that's clearly not kind of what happens.
yeah, and I mean, both my parents, they were teachers, so we didn't have anyone in our family that was really in business, but they were really good about saving their money, and they talked a lot about investing. Where my dad was real big in investing in mutual funds, so that was the first thing that I did when I started to save up my own money, was I started investing in the stock market, and then but really just kind of the light bulb went off, and so once I went to college, I'm from the Milwaukee area, so then I went to UW-Madison for college, and when I was a freshman, I'm like, I want to buy a rental property and live in it for my sophomore year. And so I did that. The first deal I bought was a duplex for about 220,000, put 15% down on it. And then I was able to qualify for the loan because I, had reported all the income from the business, so that I could just point to my tax return and say, here's what I'm making from my business. I would leave out the part where like I'm not really doing that business much anymore, but it was there, like the income to show. So got your loan approved, and I became a landlord. Yeah. So I bought my first deal when I was 19. Is 2 units. The second floor was already rented out. First floor wasn't. So then I moved into that with it was a 3-bedroom. So I moved into one of the bedrooms in that unit, and I had 2 buddies lined up for it. One of them moved in, and then one didn't. He had never asked his parents about it, apparently. So then once he asked his parents, his dad said, no, you got to live in the dorms another year. And so I was out of luck, but then I just found a random person on Craigslist to move in. So made it worked out.
Yeah,
So
just I think that's a big piece of it as well. Being able to run businesses at a young age. When you first get into real estate, obviously you're a lot younger than most people who get into real estate. I think you mentioned you got in your at 19 years old. Most people get into it when they're 40. So, and that's a good example of that. So you're solving your ability to solve problems and your ability to basically make things work. Like you said, finding other people, finding renters. Even when a renter falls through. So just kind of on that, right? So your real estate investing journey, what were some of the things that you learned, from the early business ventures that you're kind of applying when you first started getting into real estate that really kind of you would say are some of the real key lessons there?
well, yeah, I mean, I didn't know it at the time, but uh something that if you're any entrepreneur, especially in real estate, you need to be resourceful. So I did not have the answers to everything about real estate investing when I started. I knew some basics, like what I wanted to uh what was like my bare minimum in terms of like I wanted to focus on having a property that was cash flow positive, like keeping it simple, understand how they're valued with a gross rent multiplier, which is how everyone was valuing the properties there. um but really, as I like progressed, I mean, you need to go find the answers. So where I found a realtor who was also owned some rental properties himself and had a lot of clients that were buying similar properties. um then from there, once you close on the property, you got to figure out how to manage it. So then then you get a book on property management. So I just I kind of did one thing at a time with the real estate investing, and but kind of underneath all that was being resourceful. I did learn a lot about sales in this high school business, where I learned a lot about sales and marketing. And I think I was able to use that when I was leasing the properties or trying to convince somebody that I was like a serious buyer. That wasn't really a problem for whatever reason, where I think it's because I had, um, read those books, or I was able to demonstrate that was serious about this and had like a intention with what I was doing, where I'm in the dorms this year, but I want to buy before the school year is over so I know where I'm living and move into its sophomore year. Um, so I think a lot of that applied, and then really what's important is, for me, I've never done any of the whatever you want to call them, like derivatives of real estate investing, like wholesaling or any of that kind of stuff, where like this, I always kind of viewed it as this something you need to have money to invest, and then you invest it in the property with a down payment. And then later on, I figured out if you've then invested all your money, you could go out and get investors of your own uh, buy the property with them and get an additional share of the profits for doing all the work and finding the deal. Um, but really, yeah, that's kind of what carried forward. And I think like for anyone starting out in real estate, like you're not going to have all the answers. And if you wait till you do, like you're never going to buy any property or do anything. So it's important just to get started and then be resourceful as you go. You're going to learn so much more just by doing anyways, that it doesn't really, I mean, honestly, you don't need to overeducate yourself when you're starting, because just from reading books and stuff, you're going to learn so little compared to actually doing the deals and having properties and just learning by doing.
Right, absolutely. Just getting out there, right? Taking the action, moving forward, and then learning as as you go along. So another interesting thing I think, kind of in your story is when you're, just getting started investing in real estate. The first property you ever purchased was a duplex. And clearly now, your specialty in real estate investing is multifamily properties. So what kind of made that made you decide on that, and as opposed to, like you said, not going into wholesaling or flipping or anything like that? So what made you choose multifamily over, all the rest?
Yeah, and so I guess to bring everybody like to like current day, so I started a company called Breneman Capital. We have about $200 million of apartments and some commercial properties that I bought starting out as well. And so what we do now, I invest in every deal, and then we get individual investors, just high net worth folks that want to throw in money on deals and invest in real estate passively. They don't have to do any of the work. And then if it hits like a certain threshold of return, then I get an extra share of the profits. That's I guess the incentive, if you will, to have everybody along in the deal. But so starting out, I had invested all my money when I was in college. So I bought 4 deals, and I had sort of depleted my personal money. And then I wanted to learn more. So I hopped into a couple different jobs in real estate investing for larger companies. And one of them was in Minnesota, um, where a coworker of mine there, just an intern, he had heard what I was doing. We met with his dad. And then the three of us started buying property together. The three of us, we bought, um, this is in 2009 to 2011. This would be, we bought $25 million of commercial property in the Twin Cities, just one after another. Really good deals, especially at the time, because we had fresh capital buying into a really difficult market where anyone who was already investing was just working out all their problems. Not too different than what might be ahead today. So if someone's a new investor, I wouldn't discourage them at all today. I mean, you need to get going so you can, get over that big learning curve. And I was doing the same and getting my feet wet in bigger deals. And I saw what those commercial deals were like, and they're really great when they're running well. When they're full, you have huge cash flow. You don't have your operating expenses, you pass those off to the tenants. So it's really consistent when you have it full and all the tenants are paying. But we didn't have nearly the appreciation that multifamily did, where the rents grew a lot slower. We bought retail property, industrial, one office building, and there's just not as much demand pressure on those asset classes to drive the rents up and the values. And so we were getting, and then you lose a couple tenants in some buildings where we went a long time without losing any tenants. But when you do, it's extremely expensive to re-tenant the property. So that, as was a real negative. Um, and also the debt availability, where one thing that I like about multifamily is it's very easy to get non-recourse. So loans you're not personally guaranteeing on the property from a wide variety of lenders, life insurance companies, Fannie, Freddie, HUD, and the other product types, they aren't able to take advantage of the agency lenders like Fannie, Freddie, and HUD. So that as you accumulate more properties, that you start to think about like, how are these deals all set up and what do the loans look like? Because, for me, like sleeping at night now, where I have, over $100 million of loans that I'm involved in a guarantor in some capacity, but most all those are non-recourse apartment loans. So it's you're sleeping well at night compared to if those were all full recourse, personally guaranteed loans. On shopping centers where you could lose your big tenant at any minute if another thing like COVID hits or something, and businesses close again. So I got going in multifamily mostly for that. I think there's a lot of other benefits too. We went back and we bought some NCREIF data. So that's a real estate index that mirrors the private markets as closely as possible is the idea. And from 1990 to 2020, we went back and calculated all the hold scenarios, 3, 5, 7, 10 years for all the major product types. And for every scenario over that 30-year period, multifamily had the highest returns, except for one scenario. I think industrial was higher, but also then it also had the least variation in the returns. So it was the least risky if from that aspect out of everything as well. So that we liked about it. You have so many different renters in there, so you don't have to deal with that scenario that I was talking about where you lose your big, grocery store and your shopping center, and now you're in a world of hurt where a lot of these commercial deals, they have co-tenancy clauses too, where if that grocery store would close, they other businesses can pay half rent or no rent or close themselves. So you don't have that in an apartment building. You might have in a bigger one, like 100 different people, living in there, all making money, different businesses. So I like the diversification, and just it's proven out it has the highest returns. So, just kind of learn from experience, and now that's all we do, just what we focus on, multifamily.
Awesome. Yeah. So I think a lot of people, when they think, different real estate properties, right? When they think, especially when they think in the very beginning of investing in real estate, it's just single family homes. I think most people think about flipping, getting into it through wholesaling, different things like that. So for somebody who's maybe a little bit newer to investing, or somebody who's looking to, maybe they've done a couple flips, wholesale deals, and they're looking to kind of get into the multifamily space, what would be kind of like your advice, and how can somebody like that get started? Should they be finding partners? Should they be looking to kind of do it on their own? Is there different ways to do that for somebody who's looking to get started?
Yeah, I guess it depends what their skill set is, and then also too, I guess who they would know. So let's say, assuming you if you had someone that you knew could be like a quality partner that has something that you don't, whether that's money you could invest, that they could invest in the deals and you could do the work, or they have experience doing it. If you know somebody like that, I think you should partner up on your first few deals. One mistake that I see people making with partnerships is oftentimes they set it up and it's sort of like, we're going to be partners for life, which I think in business it's not really needed in real estate, where sure, if you started a business where it wasn't where you're buying all these different investment properties, there's some other company, you're going to start just anything like an app or something. You can't really like bifurcate it. You're either in it together or not. But something like this, you could say, hey, you have experience with construction. I want to buy some deals that we're going to buy and we're going to renovate. We each have money to put in. Then we're going to renovate them. Then we're going to hold them long term. I mean, that would make sense to partner up. Now you've eliminated all the risk on the construction in this example here. But then after a while, you're going to learn about construction because you're involved in the deals. And at a certain point, I would think, going to want to go out on your own completely once you've gotten over that learning curve. So I think partnering up is really great, but I think also what I'd recommend is people, they have a more of a like a timeline on it, if you will, where they can where we'll partner on all the deals the next couple of years and then we'll reevaluate, where there's not like this expectation where you're going to necessarily work together forever, because you haven't worked together. You don't even know if you're going to be good together or if you'll be good real estate investors. So that'll be my advice, but you really got to assess what sort of advantages you already have. Because again, I have way different advice for someone like me who had teachers as parents, or someone if their parents they're both doctors or have a business throwing off a bunch of cash. I'd have totally different advice what you should do. Where maybe at that point you don't need a partner. You have all the advantages from your parents essentially at that point. So
Yeah, so that makes a lot of sense. It kind of is up to the individual and like what position they're in at the moment to decide kind of how to move forward, and what is the best way to kind of structure partnerships or raise money for these deals. Because multifamily deals, they're not cheap, right? They're higher value deals, but obviously there's a benefit to that as well, as opposed to investing in just single family homes. So I think a lot of people, they're probably afraid of that, and they don't think they can start investing in real estate through multifamily. So what would you say for somebody who might be thinking about, like, they haven't done a deal in the past, but they're afraid that, to get into multifamily immediately, and they think they have to kind of like get their feet wet in other types of investments first before they can move up to that? Or is that something that you think somebody can just start out doing um,
I
the
think
very
they can
first day?
start. Yeah, I think they can start out with it. I don't think it's realistic to start out with like 100 unit property.
Right.
But, if you just think about it, let's say you've done no real estate. I mean, most people, they eventually buy a house. So let's say like you could do that, and buying like a 2 unit is not that different than buying a house. And then once you bought a 2 unit, buying a 4 unit becomes easy. Once you buy a 4 unit, buying an 8 unit's easy. And you can work your way up. So I'd advise people do that. I wouldn't start out with a 30 unit. There will be a lot of moving pieces and things that'll make that like a big leap. But I'd start out with a 2 to 4 unit, because that's not going to, the financing, just a lot of this stuff's not that different than just buying a regular house until you get above 5 units. Then the lenders change a bit. And then you just have a lot more people to deal with, as in terms of the tenants and everything. You might need to hire somebody to help you on a bigger deal. But no, I think you can do it. And I think the benefit to multifamily investing compared to the other things you're talking about, like flipping or wholesaling, like this is much more of an investment and making money slowly. So yeah, wholesaling and flipping, like that could be a great way to make money really quickly. But that's like a one-time thing. You have no tax advantages with that. You're paying ordinary income taxes. You don't have many things like kind of at your giving you any advantages, where long-term real estate investing, you're going to benefit from paying your loan down over time. The building's going to go up in value. You get to take a depreciation deduction on your taxes every year, where you're writing off essentially the building improvements, reducing what taxes you'd owe to, typically very little or none. Depends on the deal though. But it's a very different thing than, let's say, flipping or wholesaling. The risk is a lot lower because you've extended your time horizon a lot. Where if wholesaling, you have to get that contract to sign and flip it over to somebody in a tight window. So you could just lose your earnest money or whatever you put down pretty easily in something like that. Where long-term real estate investing is totally different. So it's much more safe, but it's make money slow. So compared
Yeah.
to that.
Absolutely. Yeah. So when I think of real estate investing, that's really kind of what I think, like what I think about is what's going to build wealth and passive income long term. Because if you really think about it, like flipping is it's just kind of a transactional business. It's not so
Yeah,
much
it's like a job
investing.
almost. Yeah.
Yeah, exactly. It's like a job, right? It's some people might say it's worse than a job because you're working so hard, right?
Yeah.
All those long hours, and you do get paid quite well on those, but again, like it's not necessarily investing, in my opinion.
Yeah, I agree with that. Where that could just be a really high paying job, and you always got to flip another one or contract or house to make some money. Whereas with this, this portfolio we have built up, there's 30 different properties, and I last time I checked, 28 of them were cash flow positive, and like we could make a lot of money just sitting here doing nothing now based on the portfolio we built. So, I'm still in my 30s, so I'm not in the do nothing mode yet, but whenever I'm there, like it'll be it could be pretty substantial. And then you'll get paid for a long time with it.
Yep,
So, and I think
absolutely.
maybe it'd be interesting too, where I know you have you know, like people who maybe already invest that want to start raising money potentially or something. So I could kind of dive into that too, where once you get once you've got yourself established and you've done some deals, what I would recommend to everybody is you want to specialize. So that's what I've done. Where you're asking, why did I specialize in multifamily? I mean, I specialized in what I thought would be like the best investment, obviously, but what that's also helped me, where now the brokers, they know what we buy. Where originally, like in the first few years when we were getting into the bigger deals in Minnesota, I mean, I was telling people we'd pretty much buy anything, like just send it over. Let me take a look, like in a certain price range. So then I was getting sent hotels and shopping centers, and people didn't really know what to, what we weren't really known for anything. And so I would recommend that you would specialize, because then the brokers will know what you want. You'll actually get good at it because you're specializing, where you're not trying to be a jack of all trades. You're actually going to, master just one product type. And then, two, then the pitch is the same with investors, so then the investors, when they say, why would I invest with you? like our answer is, well, we only invest in multifamily. We only invest in, 3 or 4 different markets. So we aren't trying to like, be experts in everything. We're just doing one thing really well. And even in those few markets, we only buy certain types of properties. So, I mean, one of the markets we invest in is Phoenix, and we were making a list of the properties like that we would buy. So we'll reach out to the owners, and there was 500 some properties on that list only. So in terms of like just there's not even that many properties we would buy in that, and that's one of the a top 10 city in the country. So it's once you've sort of specialized and narrowed down, like now the brokers know if it's one of those properties, they'd call us, or if we want to start reaching out to owners, we have actual criteria, like here's the ones we'd want to go after versus just like any property, in the country we buy. So
Right. Right. Absolutely. So niching down is definitely something that's really helpful on both ends, right? When it comes to acquisition of the deal and also acquiring investors to be part of the deal as well, because now you can really kind of focus your attention versus trying to, maybe learn a different thing every other week just based on what's coming across your table. So I think that's really important as well for people to kind of understand. And one of the other questions that I think a lot of people are wondering, especially when somebody like yourself, is talking about multifamily investing with, all these different, a huge portfolio essentially, what does it take to kind of really scale from, maybe owning, like you're saying in the beginning, couple multifamily properties to maybe getting up to your first 100-unit property, and how to scale that to multiple 100-unit properties and more.
yeah, so really what I mean, the big difference at a certain point, it'll be beyond what you can do yourself. So like then that's I mean, this is kind of like a obvious answer in a way, but like where the, you're where that's what was we were able to go, quite far, where I think we had maybe um 6 properties together before we hired somebody for accounting. And so really like then as you so to scale, I think one nice thing too, where depending on the and I guess, yeah, because we were self-managing all that stuff ourselves and doing the bookkeeping and finding the deals. So we were doing everything starting out. And then I think just the best way to scale it is you think of what are you either the slowest at, the worst at, don't like doing, and hire that first. Find someone who's actually like likes the bookkeeping and is really great at it. And then now that's off your plate. And then pretty soon you'll realize, okay, now actually there's so much stuff coming in from all the properties where you got to hire a property manager. And then you have that. And then pretty soon, and this is where we're at, where we've got so many different property managers sending it to us stuff. Now you need someone for them to talk to. So you need to hire a regional manager or an asset manager internally. So we've done all that over time, but it's really, for most people, I would just actually would say, don't worry about it till you're at that point where, if you don't need to worry about scaling if you haven't bought your first deal, or if you have one deal, you're a long way away from going like, wow, I have so much bookkeeping and stuff to do that I need to start hiring a staff. So, for me, it was just like slowly over time, and then been doing this for almost 20 years now. So, it's just slowly over time, we just added people. So,
Yeah, and that makes a lot of sense. I think a lot of people they think they can scale up immediately. That's clearly not the case, right? It's just over time, kind of consistently adding based on growing your rental portfolio. And as you grow one by one, you're going to add more and more pieces to that team and more uh, components to that system as well.
yeah, and I think too, and this is something still that I'm, learning about and working on, but like you're going to develop, systems and processes and improve over time, and things will become easier. But I think, yeah, just if you're starting out, you really got to just focus on finding high quality deals, having those go well. And really that's still going to be your focus kind of forever. That's still my focus, because it's an interesting business where we probably could scale and grow way faster than we are now. We just would need to push along deals that aren't as good, and then that you know isn't really like a good outcome for investors. So we don't do that. So it's an interesting business where it's like you're not just trying to scale at any cost like some of these tech companies do just to grow because they got competitors inventing a similar product or something. This is like you need to deliver good investor returns, manage risk, and have it be a good experience for them. That's how you're going to grow. It's not just about like throwing out a lot of deals. So it's
Yeah.
interesting business too for that reason. So
Yep. Absolutely. So I guess another thing I think a lot of people might want to know is just, what are you doing now to kind of analyze the deals that you have coming across your table? Because, obviously we just talked a little bit here about, being a little bit more selective in terms of, what you guys are actually getting into. So what are you guys doing in terms of analysis? Are you guys looking at, what market, the deals in? Are you guys purchasing in multiple markets? What are some criteria you think would actually be good to, use to analyze multifamily property, whether it's a good investment or not?
Yeah. Well, I mean, just kind of for what we're focused on, we have for the longest time, I was only investing in the markets I lived in. So I lived in the Twin Cities and then I moved to Chicago. And most of the deals that I've done to date have been in those markets. But I saw so much more growth in the Sun Belt that you could have bought like any deal in Texas or Arizona or Florida and outperformed the deals that were probably done in Chicago, where we have great returns. Where our average deal, I think that we sold, it's a 25% IRR. On average, but it's like in those states you could have probably bought anything and made that kind of money. So we in like at the tail end of COVID, I was sort of reevaluating like where should we be buying, what kind of stuff should we be buying. So when you're bigger, it makes sense to potentially like, okay, I'm going to pick a market that I don't live in and we'll eventually hire people there and grow it. But if you're, so that's what we've done. So we focus in Phoenix, Dallas, Texas, and Austin, Texas. That's really where we're buying these days. But if you're an individual investor getting started, I wouldn't recommend doing that. I would recommend doing what I did and buy close to home. You know what the areas are like. There's no learning curve. If you're from Chicago, you know where the good areas are, where the tough areas are. Um, you know what rents should be because you're probably, we're a renter here at some point and you have a good handle on, where people want to go for fun. And so I would depends where you're at maybe in your career, but if you're talking starting out, yeah, definitely stay close to home because you understand it. I mean, there's going to be good deals everywhere. But for us, we've trying to pick like the best markets first now and then pick deals from there. And so the deals we're trying to buy now today, really there's two types. And I think you could copy this playbook just on, on a smaller scale if you're new too. So we're buying buildings that were built from 1980 or newer. Typically between 5 and 50 million is the size we're looking. And then from there, we're really just looking for two types of deal profiles, like something that doesn't need any renovation, but maybe the rents are low or we need to assume a loan or something. It has like a little bit of hair on it where we can buy it at a really good price. Those make a lot of sense from a risk reward standpoint where you're taking on not that much risk, but you're getting a higher return than just buying like your average, deal, let's say that had the rents already at market or wasn't selling a little bit cheaper because you had to assume someone's loan. And then the other ones are ones that need renovations where same thing, maybe it was built in 1985 and it looks like it, everything's, brown inside and looks old and has carpeting. And so then we go in, we rip all that out, add in unit laundry, turn it to a more modern color scheme with vinyl flooring and quartz counters and do that whole thing, redo the clubhouse, paint the outside, redo the landscaping. So like though that's really just all we do. And so then that's, I'd recommend people follow something similar in their investing.
Yeah.
Because you get into like older buildings and you're going to run into problems. We deviated from that a little. We bought something in the 1960s in Phoenix, and we got a broken sewer stack running up 5 units that we're dealing with today. So, where if that was a 1980s building, they would have maybe used different piping, or it would have been, a lot newer, holding up better. So,
Yeah. These are all great tips, I think, for any listeners looking to get into multifamily or looking to scale up their multifamily rental portfolios as well. So, and I think you brought up a really good point there, which is some of the things that you're looking for in terms of what type of properties you're looking to buy, but also what the problem you're solving for the seller as well. Because I think that's a big piece of it, right? When it comes to acquisition of property, is why would somebody sell you their home, or not their home, but like why would somebody sell you their multifamily property, which is probably an investment for them as well. And how you're getting into these conversations directly with sellers. I think that's going to be a really important thing. So I don't know if you could maybe mind digging into that a little bit? What problems you're really looking for, how you're able to identify that, and how you're able to get into that conversation with them.
Yeah, we haven't done really much of the maybe what I see like single family home buyers
Mm.
do, where you're looking for those overgrown lawns and the foreclosure listings and whatnot. Really, most of our deals they've came through brokers but been off market. So like the multifamily investing world is really like it's kind of like a small community in each
Mm.
city where there's not that many buyers. I mean, there are many, but it might be like I don't know, 200 in Chicago, let's say, that are really like you're going to buy a property over 5 million or something. I don't know the number a broker would, but there's not that many. So then um you just want to behave in a way where you become top of mind for them. So you tell them what you want to buy, you respond to the brokers when they call you. You don't retrade the deals over small stuff. So a retrade is, let's say, um, you find an issue with the property and then you ask for the price to be lowered. So like we already, we're experienced buyers. Like we know there's going to be a problem at the property. So any property we buy, we're already assuming, even if it was a brand new building, that needs some sort of repair work. Something, I bought new buildings, and every time like something's not finished or there's a leak somewhere, and you need to put money into every building. So I'm never buying a building and saying, oh, this building's built in 1985. I had no idea this would be old. Like, yeah, I figured it was going to be, exactly, whatever, 37 and a half years, whatever it would be right now. Like that, I just know exactly how old that would be. So the only time we've ever asked for a retrade is if it's basically we're told something and it's different. If you tell us we got a brand new roof up here and this literally happened on a deal, and you go up there and it's like 20 years old, falling apart. Yeah, sure. Then that makes sense, because then you could tell them, well, you told me it was new. So then when I ran all my numbers, I assumed we didn't need to put a dime in the roof, and instead we got to spend 100 grand now. So I would say, like, follow those tips with dealing with interacting with the brokers, and that'll go a long way, because they just want to have the deals go smoothly. That's their number one thing. So then if you're known as a closer, you're going to get sent a lot more deals. And actually 80% of the deals that I've bought have been off market, but or through a broker, like off market
Mm.
through a broker, let's say, no, or a repeat seller, where I've only bought, I think, two buildings where it was truly direct. One time I called my neighbor and bought his building, and another time, but like it was mostly it's through a broker where they know this is the kind of deal I do. Like in 2020, I did 3 loan assumption deals where usually people don't want to touch those because they're a lot of work, and then you don't get a um you don't get to put a new loan on it. But those they knew I did those types of loans already, so they called me, and then if the price is right, I'll assume it, and I made it work. And it's kind of funny in retrospect, we were getting big discounts because we're assuming these really high interest rate loans in the 4s at the time, because rates were in the 3s, so nobody it was and in commercial property too, you can't just pay off your loan typically without a fee. In like a single family home or a 1 to 4 unit kind of loan, those you can prepay with no fee. But in commercial property, there's usually a prepay fee, and depending on how you structure the loan, it could be anywhere between 1% and if you opt to do a yield maintenance prepay, like back then in 2020, it was like 20% to get out of the loan. So that's why they needed someone to assume it, or they weren't going to sell. So
Right. Yeah. These are all really great tips in terms of like how to get into, multifamily deals and acquisitions. I think, a lot of people, they don't know how to get started or don't know where to look for them. But like, just networking and like you said, being that closer, right? Knowing, having the broker that's working for you know that you can close on these deals, that you're not going to kind of, undercut them or even, undercut them out of the deal or anything like that. Just kind of being that consistent closer. That's how you build that reputation for people to bring deals to you, actually.
yeah, and you really need to think long term about every aspect of this, on how you approach your deals, how you approach treating other people. Like that will get you. That's gotten me really far. Where I'm always thinking long term. Where in this thing, I never crossed my mind to say like, don't cut the broker out, because I would not ever do that. I want the broker to be happy because I want him to send me more deals. Like I don't need to
Yeah.
cut him out over a few $1,000. I'd rather have them happy with how it's going and send me another deal.
Right. Absolutely. Just long-term thinking. And that's, that's how you get to, your success, right? How do you build a big successful rental portfolio, multifamily or otherwise. So,
Yeah.
but yeah, so I really appreciate you being on the show today and kind of sharing your value and your knowledge with us. So for anybody who is listening to this, who want to learn more about what you do, who want to get more information, maybe listen to your podcast as well, what are some of the best ways people can reach out to you or follow you on social media, or what do you think people can find you at?
Yeah, if you want to learn more about our company and potentially invest in our deals, go over to breneman.com. So that's B as in boy, RENEMAN.com. And then you can learn about our company and sign up to be on our investor list, where we send out all the potential opportunities to invest to our list only. And then, yeah, I also have a podcast. Thanks for mentioning that. It's called the Breneman Blueprint. And we talk about real estate investing. But just really more sort of I mean, the podcast started out where I was more or less having all the people I worked with and my friends on, for the most part, where because they were all doing similar stuff like you. I start networking where, yeah, I have 200 million of property, but I have one of my better friends is 800, so I have him on and ask him how did he do that. And it's interesting hearing their stories. I mean, his answer was he basically worked two jobs for like 20 years to get everything built up. But so that's called the Breneman Blueprint, and then that's on everywhere you can get your podcast: Spotify, Apple. We also do it in video, so it's on YouTube as well. And then for Breneman Blueprint, we post clips on really, I think, every social media channel. And if you want to follow me, I'm at Drew Breneman on everything: Twitter and Instagram and LinkedIn, wherever. So
Nice. Yeah. So we'll make sure to leave the links in the description down below. So make sure everybody can get to it. But I want to thank you again, Drew, for being on the show. And before I let you sign off here, is there any last tips, last valuable pieces of advice you want to leave with the audience here?
well, one thing that I think is really important and we didn't talk about is just your mindset. So one thing that I see people where they're not sure they can do it. And I think there was that saying, like, if you think you can or you think you can't, you're right, or something to that effect. And I just, for whatever reason, I always thought I could do it. I never um where I was never like top of my class or anything, or but it was, I wasn't at, I was towards the top but not at the top or anything. But I would see these people that they did it, and they didn't seem any they didn't seem any smarter than me or anything. They just took a risk and put in the work. So whatever you're thinking, like, you can do it too. Everyone eventually buys a house, so it's not too big of a leap to buy like a 2 or 3 unit. Then once you've made that step, buying the next one up is, it just starts, just baby step it up, or so to speak, and you'll be able to do it too. So a lot of it's just between your ears on being able to do it or not. So
Yeah, absolutely. That's a great piece of advice. I think everybody should take that and start applying it. If you think you can, if you think you can't, either way, you're right. So, Drew, I want to thank you again for hopping on here, being on the podcast, and for our listeners, I want to thank you for tuning in, and we'll see you guys on the next show. Take
all right,
care.
thank you.